I think we should get started on our second half for this particular day, our first day. I had to fight some of you for a sausage roll. I don't think I was very impressed by that. We actually got the lovely Judy, who's running the Hyatt part of our team, to actually go out and get us some more sausage rolls. So can you give a round of applause for that? Because I think that was pretty impressive. I was very, very impressed by that. I'm a Kalgoorlie girl, and I was having to fight Mr. Keogh and some other Kalgoorlie people for the sausage rolls. So he's down the front there. I talk out of school. When you go around, there are a couple of our exhibitors who've got some prizes to give away. Interlang is one of them. They've got a beautiful bottle of red wine there that's worth, I think it's about $120. So make sure you get every opportunity to get the most out of this conference, whether it be an investment tip or a great bottle of wine or the $500 voucher for Crown. So I have a big question for you straight after afternoon tea. I'm going to test your minds. All right, here's your question. Why is BP in hydrogen? Why is BP in hydrogen? So some of you are going to say it's a bloody buzzword. Others will say no brainer. No brainer. It's indispensable. So what does BP say? That's the question. So the expert responsible for BP's train of thought, for advising BP on the development of policies and regulations that will impact clean hydrogen and carbon capture utilisation and storage in the Asia Pacific is Doleschal Ridnell. He's the man responsible. Now, you're going to come up here? You cannot do it from down there, I promise you. You're good, but not that good. While he's coming up here for his sins, we've been talking a bit about sport. This fellow here, have a look at him. He's a man that plays the long game. He supports Carlton, God bless him. But he also supports golf. And as I was walking around getting my goodies, that's for you, that's from Talon, there's some golf tees. All right, would you please make him welcome? Let's find out why BP is in hydrogen.
That's wonderful, thank you. And I was thinking of the analogy with playing the long game in Carlton, and maybe that's where we'll land with hydrogen. But thank you very much for having me today. I'm Joe from BP. I'm responsible for our policy and regulatory affairs through Asia Pacific for hydrogen and for CCUS. And I used to think that I had a very long name until I had to put it next to my title, which takes as much space and explanation. But before getting started, I'd like to acknowledge the custodians on whose land we meet today, the Whadjuk people of the Noongar Nation, and pay my respects to their elders past and present. With the brief time here today, I want to take you through three key themes. One is I'll frame the presentation on BP's decarbonisation efforts, and then secondly, specifically talk to where hydrogen fits in that and why we're going after hydrogen. And then we love all our Australian projects dearly, but I'll focus on one of them, the Kwinana Energy Hub, to talk you through how we're putting that into action. And if you'd like to buy some hydrogen afterwards, that's excellent. I'll hang around at drinks, but even if it's just for thinking through with an open mind around what role it's going to play, I'll settle with that. So the disclaimer, please don't buy any shares from what I have to say today, certainly not any legal advice. So first, a strategy. So this is a slide which pretty clearly sums up how we're going about becoming an integrated energy company. And the kind of three key green pillars are our existing businesses, resilient hydrocarbons, convenience and mobility, and low carbon energy. And then we have five transition growth engines that sit within each pillar, of which hydrogen is one. There's renewables and power, convenience and EV charging, and bioenergy. And we ultimately need to be delivering these in a sustainable and integrated way. And those are more than corporate speak and buzzwords. So what we mean by sustainability is, ultimately, the way that BP and other oil and gas companies are making money is through the hydrocarbons business, but we need to be doing that increasingly in a cleaner way, and that's ultimately helping fund our transition growth engines as we're meeting the energy demands of our customers and governments today. So at a high level, we're looking at investing $55 to $65 billion between now and 2030 in those 5 transition growth engines. And again, when we talk about integration, what that's really getting at is getting out of the practice of working in silos. So at the same time that we'll be talking to customers around clean hydrogen supply or derivative supply, likewise, we'll be talking through what CCS looks for them. So it's about being customer focused, customer first, and making sure that all the expertise that sit across our global company can be looped in at the right time for making important decisions. And likewise, I should say, for government as well, when it comes to hydrogen, some places, renewable hydrogen is going to make sense. Other places, hydrogen with SMR, steam methane reforming, and CCS is going to be what the market wants. So onto hydrogen specifically, we've got a target to market that by 2030 we want to deliver between 0.5 and 0.7 million tonnes per annum of low carbon hydrogen production. And we're going about this in a clear way. First, we're starting with our own demand. So we currently need grey hydrogen today, and then the first stop is to produce cleaner hydrogen to reduce those emissions. Second to that is that we'll scale that up and then provide hydrogen to customers in that regional centre, in that industrial cluster. And then thirdly, those hubs will build into export hubs for hydrogen as derivatives. So certainly approaching it in a methodical and strategic way. The graph up on your screen is taken from our 2023 energy outlook. So you'll see in 2019, the use of hydrogen, grey hydrogen, or carbon intense hydrogen was 67 million tonnes per annum. So for those who don't live and breathe hydrogen every day, I think that's the first thing to point out is for a lot of the particularly near-term demand, we are talking about replacing an existing product, not creating a completely new one. And again, going back to the strategy from BP, that's starting with our own, and then customers nearby who, sometimes not, but often so, will be using grey hydrogen themselves. And then you can see to 2030, it's a steady build-up. I suppose that's a reflection of the fact that we're in market creation mode, and there's a lot of work to do with government, customers, and community to build the market. But by the time we look to 2050, we see it accounting from 6 to 10% of total energy demand. So hydrogen will be needed to decarbonise the products that we currently use, and these are quite often critical products. So to use the namesake, this includes critical minerals, it includes ammonia, aluminium, and steel. And again, this is something that's often overlooked. And hydrogen will also be needed to decarbonise our hard-to-abate transport fleet, to firm grids, and for many countries that don't have access to cheap and abundant renewables in the power sector itself. So I mentioned we're in market creation mode, which means that strong partnership with customers, with government, with community is needed to grow the full value chain. It's not enough to be able to produce hydrogen at a price, at a cost that a customer is willing to pay. You actually need to get it to them, which often requires that midstream infrastructure development. And so ultimately, as we move through to 2030 and 2050, it's going to be the right policy settings, We expect further technology learning curves and ultimately moving to scale. So talking about projects we're kind of talking Hydrogen Head Start, a $2 billion Australian dollar fund is looking to get us into the tens of megawatts scale, but ultimately we need to build on that to get larger scale, and that's where the commercial hydrogen sector is going to emerge. So this is I won't spend much time on this slide, but this is currently our hydrogen pipeline. You can see we have 3 projects in Australia. I'm going to speak more about the Kwinana Hydrogen Hub, but I'll mention the Australian Renewable Energy Hub that's located in the Pilbara mega scale project, 26 gigawatts of renewable generation, which is an incredible number to wrap your head around. So it is going to be a phased project. And I just mentioned that because when I was working overseas, there were 2 things that people knew about hydrogen a few years ago. One was Andrew Forrest, and the other was the Australian Renewable Energy Hub. So BP became operator of that last year and progressing very well. But onto Kwinana, and I wanted to touch on Kwinana both as one of the nearer term hydrogen opportunities for BP globally, and also because we're talking about, when we say energy transition in action, this is really it, where we're repurposing a site to produce new products and then being able to use some of the infrastructure that's there to best utilisation. So picture on the left is what the site used to look at. There's been some demode work since then, so it looks quite different now. On the right, you'll see in the red is the Kwinana Renewables Fuels Plant. We announced earlier this year when the Minister, now Premier, was out there, Roger Cook, that we'd gone into FEED, and we're hoping to make a final investment decision for that at the end of the year. And in the green box is the location of where the future hydrogen production facility would be. And then you see the loadout jetty there, which at the moment kind of accepts our fuel into the state, and we transitioned the refinery tanks into an importing terminal. So ultimately, for the renewable fuels plant, hydrogen is a feedstock for that. So that will be a critical anchor customer. And then likewise, nearby, in the Kwinana precinct, there are several users of hydrogen, which together with Kwinana Renewable Fuels, we see that 100 megawatt electrolyser capacity being able to meet. We think that the ability to supply domestically and be able to export is going to be a real comparative advantage for Kwinana and for BP more broadly. So we'll start off with that domestic supply. It's got existing transmission connection there. It's got the land to build out the electrolyser, and importantly, it's got the port to move it. So phase 1's planned for 100 megawatts, phase 2 into the 400 period, and then if we look to the future, there's the potential for over a gigawatt. So again, if I return to the strategy of BP globally, very much aligned with how we see the market developing, starting with our own demand, renewable fuels, looking elsewhere through the industrial cluster for offtakes, and then finally into export. The other thing to note is that we've commissioned work on how a grid-connected electrolyser operates in the system. And our power strategy is to bring on new renewables to complement our demand. So that, combined with being able to flexibly use the electrolyser, so switch off at certain periods, actually delivers positive network benefits. So I'll move through to the conclusion. We can't get a hydrogen market created without partnership, and would like to acknowledge the support we've had so far from the federal government, which has been $70 million commitment for capital spend for the project, for the hydrogen hub project, and from the state government that really helped us get the feasibility work underway for the project. Hopefully, I've left you with a clear sense of our purpose around BP's strategy of decarbonisation, why we're going after hydrogen, because of its role in the future energy mix, and then one example of how we're trying to realise that here in Australia. So with that, I will end, and go Blues. Thank you.
I did just look up the odds for you. They're paying 12-1 for Carlton to win the grand final, that is, so you're still in with a chance. All right, next presenter is a man called Alexander Underwood. Where is thou, Alexander Underwood? Great. Well, I come looking for your Alexander Underwood so I could get a little bit of a pre-say about your presentation for everyone. Instead, I had to go with what I was looking for last night. So it's always good fun to research the people that are coming up here first, just in case they've got something in their past that we can talk about. Do you know there's 4 Alexander Underwoods in Australia?
No, I did not know.
There are. One of them is doing a doctorate in post-viral complications with SARS. The other one is, what was the other one? The other one is doing a he's an Aussie in Europe who is weightlifting and a CrossFit champion. And the other one is a musical motivator. And then there's you, number 4, the CEO of Empire Energy, mission to continue to progress Empire's mission to commercialise the Beetaloo Basin and bring down the cost of gas on the east coast at times when it's unsustainably high by finding us more gas. Would you please make him welcome, Andrew?
Thank you for the warm introduction, and it's great to be back at Goodall. I've actually been coming to this conference for about 15 years now, and great to see a really good audience here today. Yes, I'm the CEO of Empire Energy. We are focused on the Northern Territory's Beetaloo Basin. I've been in this role for about 5 years, and under new management, we've been one of the most active players in the basin, and it's our view that we'll be the first company into commercial production, hopefully in early 2025. So, I guess a number of the investors here have probably heard a number of stories from smaller oil and gas companies today. So I thought I'd just start with a bit of a scene set of, why Empire? Well, we do have a truly globally scaled resource within our tenement that I'll take you through in a bit more detail shortly. We've got over 1,900 petajoules of 2C resource, and that's only with a very limited amount of drilling. We have very strong support from government, particularly the NT government, that's put enormous effort into establishing a regulatory framework. Gas is a critical part of the NT government's strategy to get to $40 billion of territory GDP by 2030. We've delineated a very large-scale resource, and now our very strong focus as a company is on moving into a pilot production phase. That's about 25 terajoules a day, which at current gas prices would be somewhere in the order of $80 million a year of revenue. But then there's very substantial upside from there, where we'd be looking to connect into Australia's east coast and ultimately to LNG export through existing terminals in Darwin and potentially Gladstone for that matter. So we have a very large position in the Beetaloo. We have nearly 29 million acres under lease. We have a 100% working interest in all of our properties, which gives us significant funding flexibility going forward, potentially through farm out. And as I mentioned, we've booked a resource from a standing start 3 years ago of 0 petajoules of 2C contingent resource. We're now up to 1,900 petajoules, and that's a subset of a prospective resource of over 44,000 petajoules of gas. So, this is one of the really interesting things about shale gas, is that you have these huge volumes underfoot, and our focus now is really on getting into production, continuing to demonstrate the productivity of these wells, and then looking to grow from there. So as I mentioned, we had no contingent resource in 2020. In 2021, we drilled our first vertical well, Carpentaria 1, our discovery well. We also acquired properties from Pangaea Resources, which was a very successful private Australian company that did very well out of the coal seam methane boom in Queensland in years past. In 2022, we carried out an extended production test on that vertical well. We also drilled our first horizontal well, Carpentaria 2H. We carried out a further seismic survey. That saw a further lift in 2C contingent resource. And this year we've had a really busy year. So we've carried out extended production testing on Carpentaria 2H. We've also drilled Carpentaria 3H, the longest horizontal shale well in Australian history. That was also the largest fracture stimulation job in Australian history, and with very encouraging results. As you can see on the right-hand side here, we're now starting to get to the point as a company where we can start to develop a sense of project-level economics. And based on our 2C resource, we're looking at indicative well costs in the pilot phase of around $2.50 a gigajoule. But with shale gas, there's a very well-established trend in the US where the more you drill, the more the costs come down and the more economies of scale you get. And we think we can bring those development costs down below $2 a gigajoule. So we have a very large resource. We think we're pretty cheap, but I don't know many small cap oil and gas companies that don't believe they're cheap. But you know, once we can prove the commerciality of this project, we see very substantial appreciation potential in our share price. You know, particularly when you look at the comparable valuations of other Australian companies. As I mentioned, the gas is a key pillar of the NT government's plans to further develop their economy. So the Middle Arm project is a substantial project that's underway in Darwin Harbour. There are already 2 LNG export terminals in Darwin Harbour. One's owned by Santos and the other one by INPEX, the Japanese company. And there's $1.5 billion that's been committed by the federal government to further developing the Middle Arm precinct. So we're looking at, first of all, carbon capture. This could be one of the largest carbon capture hubs in the world. And also facilitation of additional activities such as processing for battery metals and so on and so forth. So moving to the projects themselves, we've got acreage on the eastern side of the Beetaloo and the western side of the Beetaloo. The Carpentaria project is the area where we've been focusing recently. That's where we've drilled our 4 wells. And then on the western side of the basin is the properties we acquired from Pangai Resources. If you compare the size of these tenements to, say, US projects, these are enormous projects. We've got about 110,000 acres in our Carpentaria project, so sufficient running room for hundreds of development wells. And then we've got about 1 million acres of drillable area on the western side of the basin. And this gives you a bit of a sense of the scale of this project. So the Marcellus Shale, it was really the gas basin in America that saw shale gas take off. So there's been around 27,000 shale gas wells drilled in the Marcellus. It currently produces around 25 to 30% of America's total natural gas. And it's been a real driver of, you know, bringing downward pressure on gas prices in America, but also reducing the carbon intensity of the US economy, because coal-fired power in many areas has actually been displaced from a cost perspective as opposed to any government mandates through shale gas development. The size of our tenements you can see in the bottom right box there are compared to the entire Marcellus Shale, which covers 5 US states. So we have a very large acreage position. Now that the Marcellus is in a mature phase where it's more of a manufacturing type process of drilling wells in known geology, typically acreage in that basin trades at anywhere from $5,000 to $25,000 an acre. You compare that to valuations in the Beetaloo, where we're, you know, in the tens of dollars an acre currently. So again, we see very substantial upside potential as we prove up this basin. So as I mentioned, Carpentaria project in EP 187, that's our focus. We've drilled 4 wells, we've delineated a substantial resource, and now our focus as a company is on bringing this project into production. One thing that's quite fortuitous for us in terms of this pilot project is that there's a pipeline that traverses straight through the middle of our tenement. It's only about 5 or 10 kilometres from our drill sites. It's owned by Power Water Corporation, which is an arm of the NT government. And we've signed an MOU with Power Water to use that pipeline and also to potentially sell gas to them in the pilot phase. The East Coast gas crisis is very well reported in the media, but also in the Northern Territory, there's very substantial tightness in the market. One of the predominant sources of gas for the domestic market is called the Blacktip field, which is operated by ENI, the Italian National Oil Company. And that field has been underperforming very dramatically, as a result of which the NT government is actually buying emergency gas supplies from the LNG exporters that would otherwise go to Asia. So you can imagine they're paying very high prices for that gas. And so there's a real impetus from the government to help us get into production as quickly as possible so we can bring downward pressure on prices within the NT local market. I'll just quickly touch on the horizontal wells we've drilled. So Carpentaria 2H was our first horizontal well. We drilled that well to about 1.35 kilometres of horizontal section. It was all within the target zone. We carried out a 21-stage fracture stimulation job on that well, and we've achieved very, very exciting flow rate results on that well. So we've carried out 2 flow tests, and we've achieved about 3.5 terajoules a day. In shale gas development, once you can prove that you can drill these wells and frack them to 1 kilometre of horizontal, you tend to go to 2 or 3 kilometres in development wells. And what this is showing us is that we would expect to get over 10 terajoules a day of production from development wells, and the independent assessment is around 8 petajoules of gas per well. To put that into perspective, at a $10 a gigajoule gas price, you're looking at around $80 million of gross revenue per well. And these wells in the development phase, we believe will initially be around 20 million bucks, but we can bring it down to 15. So they should generate very strong returns. We then went and drilled Carpentaria 3H. This was a significantly longer horizontal section, so nearly 2 kilometres of horizontal section fracked, and we carried out a 40-stage frack. We've recently just reopened that well, and we've seen a 30% uplift in production in the reopening phase. I should stress that this is very much the way we design the fracks around these wells. There are a lot of variables that you can use to execute a frack, and so we're really just starting to get up the learning curve. And what we've seen in America is that productivity in these basins improves continually as you optimise your frack design. So very encouraging results at this early stage where there's a lot of optimisation yet to come. On the Western Beetaloo that I mentioned, we haven't been so active in that area. We've been very focused on allocating our capital in a focused way on EP 187, but our plan for next year would be to go into development drilling, which would build on substantial work programs undertaken by Pangaea in around the 2013 to 2016 period. Sustainability is incredibly important. Australia now has a hard cap on emissions. There are specific provisions related to the Beetaloo that require us to be net zero for Scope 1 from day one. One of the very fortuitous elements of this basin is that we actually have extremely low CO2 in the reservoir. In our areas, it's less than 1%, and that reduces the offset challenge for us. If we were just to simply go out and buy ACCUs, which would be probably one of the more expensive ways of offsetting our emissions, we estimate that that would cost around 2% of our revenue stream to fully offset Scope 1. The Beetaloo is an enormous resource. There is currently quite a lot of gas pipeline infrastructure in place, but it's limited. So we have a 25 terajoule a day opportunity through the existing pipeline. There's also an existing pipeline called the Northern Gas Pipeline that connects Northern Territory to Mount Isa. That was built a few years ago. But we've been doing a lot of work with APA Group, and we were delighted that we and APA announced a partnership just in recent weeks. APA's focus is on building a very large pipeline to connect the Beetaloo to Mount Isa, from which they have a full extensive network of pipelines right across Australia's east coast. APA is going to start spending money under that agreement now, and they're also looking at potential ways to support us in the early phases of our projects, such as potentially funding surface infrastructure, which we think would be great because, obviously the cost of capital for very small companies is very high, and they see that as an enabler towards their larger scale project. So just to round up, I thought I'd just step you through where we've been to date and where we're going. So, I'm very proud of our company's track record of doing what we say we'll do and doing it in a very, in a manner that protects our shareholders' capital. So in 2021 and 2022, we started drilling, carrying out seismic, started proving up the resource. signed MOUs with APA and Power Water Corporation, and the APA MOU has now progressed to a more concrete agreement. We also have a credit facility with Macquarie Bank. I worked there for 10 years, which is designed to grow into a project finance facility. Earlier this year, we've had great flow rates from our wells, further increased the resource, and now, as I mentioned, our focus is very much on getting into that pilot phase, and once we get that up and running, get production going and get a revenue stream growing, then we'd be looking at much larger production into Australia's east coast and ultimately into LNG export. So thank you very much for your time and for listening.
Perfectly timed. Thank you very much, Alexander Underwood. Brilliantly presented. Right, next up for your consideration, the best 2P gas reserve on the East Coast, yet to be connected. The company, Comet Ridge, and they're very close to signing their first gas sales agreement. Very exciting times. Heading the charge, this man, he walks fast, Tor McCaul, MD. Oh, hey, I don't know if we have insurance for that, just be careful. All right, would you please make Tor very welcome, everyone?
Thanks, Chrissy. Always tough to follow Alex at a conference. I personally prefer to follow John Phillips from Blue. Makes me look intellectually very smart. So if any of you got John on a text, can you please send that and let him know that I said that? We go back a long time and it's upsetting when he's not here and I can't do it to his face, but I'll do it anyway. So I agree with Chrissy. We have what I believe is the best unconnected, yet to be connected 2P gas reserve on the East Coast. We have a lot in common with what Empire are doing. We're also looking for a 2025 start, and I'll run you through that. I've only got about a dozen slides today in total. So important disclaimer, do your own research, make your own decisions. In terms of our key achievements over the last 18 months, there's been quite a few. We've had a very, very busy time. I'll show you some maps in a minute which will explain this a little better. But one of the things we've been able to do in the past year and a little bit is to buy APLNG Origin out of our Mahalo gas project. We were able to borrow $13 million from Santos to do that, who are also our JV partner. And then Santos exercised an option. So we've rebalanced the joint venture from a three-party joint venture that wasn't moving quickly to a two-party joint venture that will now move much faster. We've had a big increase in reserves and resources late last year. I'll give you a slide on that. And as Chrissy mentioned, we're also about to sign our first gas sales agreement. It's been delayed. The government, as many of you will know, gave us a big boost last December, intervened in the gas market on the East Coast, and that basically just drove everything to a grinding halt. We're through that now, we're up and running again, and I'll talk a little bit about that, but we're excited. We've said in an ASX release not long ago that we plan to sign that GSA around the middle of this month, which is really sort of next week or the week after. As we move on, I don't want to talk a lot about what the government's done in December and how they've unwound it by July. By the time we got to February, they'd realised they'd made a mistake. By the time we got to July, we've got a mandatory code that exempts most of the small producers like ourselves. How government was going to calculate a rate of return and tell us what our gas prices were going to be and still expect shareholders to tip money into this project kind of confuses me and just makes no sense. So luckily, we've seen sense. Luckily, we've now got an exemption system that effectively exempts the small cap producers such as Comet Ridge, as long as we're producing gas to domestic market. And right now we see domestic gas prices as strong and remaining strong, and potentially as we head into this decade, getting stronger and stronger. If this is a slide I felt I had to put in this time, and as you read the newspaper, I think all of us just shake our heads sometimes. How do we get so polarised on natural gas? Part of the population realises that without oil and gas and coal, our whole world comes to a grinding halt. From our tennis shoes to our tennis net to the eyeglasses that I'm wearing now that I wouldn't have. But anyway, it is what it is. It seems that our industry is generally we focus on what's technically achievable and commercially sensible. Not everybody does that. Governments now seem to be driven by ideology. But ultimately, in the end, physics wins. We have to have gas to support the electricity network. We have to have gas to actually generate the minerals that are needed for renewables. We have to have gas for manufacturing. About, I think, 2/3 of the world's fertilisers come from natural gas. So without it, we starve. So if some of the newspapers continue to want us to tell us it's all off, it's all over, that's fine. But I think most of us in the room know that's not true. This is where Mahalo Hub sits north. If you think of this as a high heel shoe, the lime green areas are the producing areas that the big LNG companies produce from, Arrow, QGC, Shell, APLNG Origin and Santos. Also, there's some smaller producers in there as well, Central, Cenex. We sit with the Mahalo Hub up to the north. We're strategically only about 240 k's to the west of Gladstone. We've been able to be in our joint venture that I just mentioned, where we've extracted APLNG Origin through a sale, but we've also won 3 new blocks up in the north, which are coloured orange. Queensland is really a jurisdiction you want to play in natural gas. The government's had commercial production since 1969. Roma had gas reticulated around the town in 1912. So Queenslanders know about natural gas. Both sides of politics are comfortable with it. Gas business is good in Queensland. We get stuff done. We get stuff done quickly. In terms of our reserves, this is the booking I mentioned not long ago. If you start with the grey box on the bottom left, if you go back to 27th of June last year, our corporate 2P recoverable reserve net to Comet Ridge was 106 petajoules. We then acquired, formally the next day, we signed up and paid the money and acquired APLNG Origin share of Mahalo, which pushed us up another 46. Late in the year, we had a very successful pilot. Late in 2021, we went and drilled a wishbone lateral well, if you like, a long horizontal well in coal. We did a branch off that. We got to nearly 1,900 metres in coal, and that well flowed 1.75 million standard cubic feet a day. So a little bit less than the rates Alex is talking about, but we're spending less money on those. We're not fracking, so we have to spend less money to get that sort of flow rate. So the combination of that took us to 195 PJs of 2P. That's Comet Ridge net recoverable reserve, and we're working now to increase that as we move to get our Mahalo Hub into production. And what I see us doing is appraising as we go and building our reserves base as we go. Pre-development spend is always tougher to get. You've got to go around to your shareholders and raise money. If you've got FID on a project and you've got your funding in place and you're moving forward, you can always step out and drill that extra appraisal well and tie it back in. It's not flaring gas, it's making money for you right from the start. So I see us as appraising as we go. This table is kind of interesting because it shows our total reserves and resources over the Mahalo Hub area in columns of 2P, 3P, 2C, 3C. We've also got a big position in the Galilee Basin with nearly 2,000 PJs of contingent resource, but that's not for today, that's for another time. The map's interesting because it subdivides the Mahalo JV block we have with Santos in the grey, which Comet Ridge is 57% and Santos is 43%, and also the orange, which we've won from the Queensland Government over the past 2 or 3 years by competitive tender. So we're very grateful for the Queensland Government that they've had the confidence to award Comet Ridge 3 blocks at 100%. It gives us a very, very material position in the area. The grey with Santos, the northern or the darker part of that grey to the north, or the centre of the map, but to the northern part of the grey, PLs, they're petroleum leases, they're fully approved for development. So that's been done, environmentally approved, tick to go. We're now about to submit our first application environmentally and for development in the number 2 box, which we'll submit over the next couple of weeks to state and federal government, and also the development application to state government. There's a dotted blue line there that's hard to see, but we're talking to Gemina about being our infrastructure provider for Santos and Comet to sign up with Gemina to build the pipeline that we need. That'll be a little bit under 80 kilometres, and we then take that CapEx out of our project and we pay a tariff for use of that pipeline. It makes a lot of sense for us. So really the 2 key reserves numbers there to look at, 195 2P net to Comet Ridge in petajoules, and a 2P and 2C of just over 400. So we've been able to build that, and we plan on continuing to build that as we go forward. The path to production for us is really quite simple. It's Gemma to provide the infrastructure which gets the Mahalo JV project in. It gets our Northern Orange 100% blocks in. We've got a GSA we're about to sign with CleanCo. We've got a non-binding MOU with Orica that we're working through a process to look at prepayment. I think there's a path here for small producers like us to take CapEx in from gas producers up front, and then to gas buyers up front, and then to actually produce gas for those buyers later at a slightly marked down price, which enables the customer to recover their capital. Many of the companies we're talking to sell gas, about selling gas, have balance sheets bigger than ours. And it's not very difficult for them to open their wallets a little bit to tip some CapEx into the project. It gets us funded, it gets us up and running, and then they're receiving a gas price down the track that's a little bit less than market price. I think Mike Dodds from Vintage is here. Vintage has done a very good deal like that with AGL just in the last 6 or 12 months on Vale, where AGL put money into the project and then takes gas at a slightly discounted price. So we're working both our Northern Mahalo hub block, Mahalo North, Mahalo East. We're also working with Santos on the bigger Mahalo JV block where they're the operator. We've got gross 2P there of 266, and as I mentioned, we've got net of 195 across that whole area. We're planning to grow our reserves and resources as we go. We've got Gemina plugged in now, and we've just done a pre-feed study with Gemina. We're about to go to a full-blown feed study. We believe that will put us in a really good spot to FID the project in second quarter next year, and that gives us gas around the same time that Empire were talking in 4Q 2025, although Alex might be a little bit ahead of that. But we're working very hard so that within about 8 quarters, we're up and running with gas production, and we do expect the market to get tighter and tighter as we move through this decade. We're pleased also to have quality partners, I guess, if you'd like to call it that, on this project, with Santos as our JV partner and Gemina as our infrastructure provider. And we're also looking at the moment around our compression facility and how we might also tariff or toll our compression so that that's not front-end CapEx, that's actually paid through OpEx as we go forward. This map on the right is one of my favourite. The green, the U horseshoe shape, is our high-quality fairway. We're batting 3 for 3 on that fairway where we put lateral wells in there. The blue table on the left shows that the bottom one is our first one, which was a little baby one at only 360 metres. It flowed nearly 1 million cubic feet. We then went to a teenager. We went to a 900 metre lateral. It flowed 1.4. We've gone up again to a dual lateral that's nearly 1900 metres and 1.75. What's really pleasing about this last one is it's a single production well lateral doing all the heavy lifting on its own, and it managed to get 1.75 million cubic feet on its own. Generally, in our industry, a pilot would have 3, 4, 5, 6, 8, 10 different pilot wells, and we've been able to get this one to work on its own. So we're very encouraged with where this will go. As we get longer and longer wells, the economics gets better and better. And we've heard recently Santos has drilled a 2800 metre lateral, and they're now moving out to 4000 metres. So we see the economics as improving all the time in a very strong gas market. Well, that's interesting. So we've simplified the JV structure. We're extensively appraised with our project. We know a lot about it. There's more to learn, and we'll step out and appraise as we go. We're processing the infrastructure solutions. We see this as 2 separate projects where we participate in both, feeding into the one pipeline. We're 57% in the grey with Santos, and we're 100% in the north on our own 100% blocks. So we think that gives us quite a lot of strength. Really, the pipeline connection's the final piece of the puzzle that we're putting together now that sits just aside from our environmental approvals, which we're just about to lodge also. But we see a big diameter pipeline, 10 or 12 inch diameter, less than 80 kilometres. One big gas hub requires only one big pipeline. I think that's fairly simple. We're also looking at a westerly option that's possible, but we're sort of just trying to line up the schedule on the main project first, and then we'll make a decision on the quicker east westerly connection, if you like. So key messages: gas is here for a long time. The East Coast market is strained. It will be strained for a long time. There's a lot more molecules need to come in. The hub we've got just west of Gladstone is a big piece of business. We think it's the best quality 2P not ready not already connected to the market. And we're in a good space in terms of pipelines and infrastructure. And really just that's the 20 seconds left. That's the corporate overview slide, trading about 16.5 cents. We've got a market cap around the 170 million mark and 10 million of debt through a fund we worked with a year and a half ago in terms of issuing some warrants. That's all. Thanks for your attention. I'm here for today and tomorrow. Come talk to me. I'll be out on the booth.
Good on you. Good on you, Tor. Thank you very, very much. Now, 2 years ago, our next company was a bit of a work in progress. Now they're producing from one gas field in the Cooper Basin. Production from a second is imminent. So 2 gas fields producing into a really strong eastern states market. The first time they've gotten into revenue generation, and the MD who's cracked it is this very stern-faced gentleman up here. He's a mad keen Scotsman, a golf mad Scotsman. Yeah, so there's one for you too. Yeah, take that, Mr. Aitken. Excellent, right there for you as well. So now, and your favourite golf course, I found out, is up where Mel Gibson flashed his kilt. Wallace's Monument, is that what they call it?
Yeah, Stirling Golf Club.
So if the oil and gas thing fails you can always go and have a chat with him about golf afterwards, and he'll convert you to his project as well. Make him very welcome, everyone, please. We're talking Metgasco.
Okay, thanks very much, Chrissy. It's good to be back at the conference. I missed out last year. I was playing golf in my favourite course in Stirling at a family wedding. So it was 2 years ago when I last talked to the conference, described our 4 gas discoveries in the not-to-be-forgotten Cooper Basin. I think I'm the first presenter in the Cooper today, 50 years in the making and still producing a lot of gas. So we've got an emerging new gas production hub. I said it was going to be emerging 2 years ago, and I'm proud to say that we have 1 field online as of February, and later this month we'll have a second field called Odin online as well. So please do your own research, read the disclaimer, and we've got some reserves and resource notes as well on there. So on the highlights side, sort of give a quick overview. Metgasco are a highly undervalued small cap ASX listed company who own 25% of Valley in the Cooper Basin and the Odin field. So Valley started production in February, and Odin's coming along, as I said, later this month. There are a few companies which graduate from exploration success to producer status in less than 4 years. So it's really the presentation. I'll explain our strategy and the gas market dynamics that allowed Metgasco and its partners to commercialise these 2 gas fields. I think it's a good story that you'll enjoy. I'll finish the presentation with a summary of the exciting catalysts. Some of them are very near term, which should excite some new investors and current investors, and also look forward to what's happening next in the field. So I thought I would explain the sort of business transformation. Some of you will remember way back pre-2016, we were a coal seam gas player in the Northern Rivers assets in New South Wales. I took over about 5 years ago, and it was just about the time where the company had gazetted 2 Cooper Basin blocks, and also I managed to get into an asset in the Perth Basin, and we also were in the Gulf of Mexico with Byron Energy. The power of a good exploration portfolio is not everything's going to work. I'm very proud that we have had a 4 from 4 drilling, 3 in Valley and 1 in Odin. The wells at the Perth Basin, the Gulf of Mexico, which were chasing oil, didn't work. So over the next few slides, I'll explain the key catalysts in the journey to our first gas. Yeah, so the company snapshot. Current share price is around about 1.2 cents, and the market cap is around about 13 million. Pretty low compared to the fact that our net Valley and Odin gas reserves of 35 petajoules. So if you're about $1 a petajoule, we're probably a third of what we should be valued at the moment. In March, we secured a $5 million debt facility, and we got supported by 2 of our largest shareholders, which is an excellent sign for any company that your shareholders believe in what you're doing. The map on the right there shows the ATP 2021 license, and it contains the Valley field, the large field in the red, and you can see the 3 wells that have been drilled. Odin overlaps the boundary to South Australia and Queensland, and about 50% of Odin is in each license. So what is the overall strategy here before we get into the specifics of how we managed to unlock the catalyst to production in 4 years? It's very much a hub and spoke strategy. I talked 2 years ago about having a string of pearls. There's lots of exploration upside. So we've drilled 4 good gas wells. We're going to bring them the 4th one into production soon, and ultimately we want to drill and tie in numerous gas prospects. You can see oil prospects in the dark blue on the map, and they're all very close to our production infrastructure. So the idea here is basically fill up. We've built the pipeline. We've got a path to market. It's a 20 terajoule a day facility. The gas price is good, and I'll talk about that in a minute. It's a very high margin gas project that will allow us to generate significant revenue. So we want to get that revenue, grow the business, and expand our footprint in the basin. So really, the story of farm out to production in less than 4 years. You can see the geological aspects down in the bottom right of the wells. We're in the Permian from the gas side, and there's potentially some oil in the Jurassic, which we'll be chasing in the future. But over the number of years, we have really pushed hard to develop and drill our wells, and spent the last 3 or 4 years, a lot of it during the COVID period, and moving forward in the project. About two weeks ago, I presented to the SPE. Thanks to Steve. I think he's in the audience for giving me the chance to present to the society. That being a petroleum engineer myself was great to do. There was a really good presentation on why we gazetted all the technical aspects of why we got into the permits that we did. 600 BCF within 20 kilometers of the boundary was one of the reasons. And there's also 11 million barrel oil field at Doleschal. So we're hoping for some oil in the future. So the way Metgasco did this and commercialized the project, we owned 100% on the Gazettal. We farmed down to Vintage, who are the operator, 50%, and Mike Dodd will be here tomorrow to talk about the same project and the others that they have. And we also farmed down 25% to Bridgeport. And that meant we got a free carry on our first well, the Valley 1 well. We tested a post-stimulation rate at 4.3 million standard cubic feet a day, which is excellent for a low permeability reservoir. We followed up with 2 Valley appraisal wells in 2021, and that allowed us to go to the independent expert to get 101 petajoules of gross gas booked for Valley. So moving on to Odin, you could see that, and I mentioned earlier that the reservoir straddles the two licenses. We didn't want to drill in the Odin side and give them a free kick to the operator on PRL 211. So what we did is we did a farm-in deal, and we got some interest. That was the 3 joint venture partners. We struck that 2 or 3 years ago. We drilled the Odin 1 discovery when we drilled the Valley appraisal wells. And that turned out to be the best of all of the wells. Had a great net pay, tested gas, and really much better permeability and porosity that Valley had. Flowed naturally without stimulation, 6.5 million standard cubic feet a day, 1800 psi flowing wellhead pressure, which those of you who follow these things, that's a pretty great rate. So Odin 1 is only 1.4 kilometers. You can see that we ran the pipeline from Valley into the Beckler field where we tie it into the Santos Moomba system. We ran that past the Odin 1 well, and it's only 1.4 kilometers away. So the gas market, it's a great time to be a seller in the market. It's amazing. The ACCC report, which I quote on this slide, basically said there's a 30 petajoule shortfall in 2023, and you can see the supply-demand gap over the next number of years just growing. So basically, because of the offshore fields, the Gippsland fields and the Otway fields declining very rapidly. So it's a great outlook for the gas price. And as Tor said, the small cap companies are basically, we are exempt from this $12 a gigajoule price cap. We'll be producing less than 100 petajoules a year, and we're providing all our gas to the domestic market. So Metgasco's goal is, and the very lowest bullet point says this, is to deliver as much gas to fill our 20 terajoule a day pipeline and facilities at Valley, and continue to do it through the period where the supply-demand gap is there. And we're getting in before the Beetaloo producers, he says with a smile. So on the overall resources and reserves, we've got two really good gas customers. In mid-May, the PRL 211 JV signed a GSA with Engie, and it's Engie Mitsui joint venture run the Pelican Point power plant in South Australia. So it was good to get a South Australian customer. So we signed up for all of our Odin gas to the end of December 2024. We got ACCC approval to market beyond that, and we're at a very advanced stage of marketing for the next tranche of Odin. And so we're underway doing that. Odin has 39.7 petajoules of 2C resources, which probably in a month or so's time will convert into reserves. And the majority of that is uncontracted. Well, as I say, we're working on that now. So Valley 1, going back to Valley, you can see in the bottom donut chart, has 85 petajoules of uncontracted gas. And we've got 16 petajoules that's contracted to AGL. And as Tor said, the commercial team at Vintage, with our support, did a great deal of helping develop and pay for some of the costs of the development of Valley. We got a $50 million prepayment, where it's a win-win, where AGL got a reduced gas price. So I think that was a great deal, and well done to the commercial team to get that pricing. As I say, it's tiered pricing, so we still get paid for the gas that we produce. So just focusing in on Valley, what we're doing right now. So Valley 1 has been producing extremely well, and it's producing to model rates. It's just under 4 million standard cubic feet a day of raw gas selling to AGL over the last quarter that we quoted in our quarterly report. Valley 2 and 3 have taken a little bit longer to come on. There's more fluid in these wells, and bringing these 2 wells on has been delayed. We're pending fluid removal in the well bores. We've run a production log, and we're just reviewing what we need to do from a root cause analysis there, and work is ongoing to bring Valley 3 online. On the Odin side, we've basically took the decision due to the proximity to do a fast-track tie-in in November last year, and that is almost complete, and we're getting close to the commissioning, and as I say, that should be later this month. A 1.4 kilometre pipeline was installed when the Valley pipeline was put in back in January. It's basically a rental equipment for the short-term production, so we're basically paying a little bit more operating costs, and the long-term pipeline will go back to Valley to use the production facilities there. And it's the first example of our Metgasco hub and spoke strategy. Getting close to the end, so we've got a number of approaching catalysts. The first gas from Odin, as I said, in September. the restarting of production from Valley 2 and 3, securing a second GSA. We're very advanced on that. And then basically looking to the next year and drilling at least one Odin well, and the joint venture is reviewing that and just looking to see potentially what rigs are available. Again, we want to fill that production hub up to its maximum capacity. A final slide from me, and basically on conclusions, it's the same one you saw at the start. Metgasco is a revenue-generating producer, which will use that revenue to fund growth. We've made that transition from explorer to producer. We've done it very fast. We have a flexible onshore gas strategy and are reviewing other business development opportunities to expand our footprint in the Australian onshore basins. Lots of near-term catalysts. And as I said earlier, we're at bargain basement price. So it's a pretty compelling opportunity if you want to get into high margin Cooper Basin gas production. Many thanks for the chance to tell the story today, and I'm around the conference for the rest of today and tomorrow. Thanks very much.
Well done. Do you have to wear kilts when you play golf over there?
Sorry?
Do you have to wear a kilt when you play golf at that place?
Definitely enough, it's windy.
Too windy, no. We don't even want to visualise that. All right, our final presentation comes from Elixir, a gas explorer and appraiser in Australia, and they're also in Mongolia. Lots has been happening with this team. New ground in Australia, which is ready to be drilled next month, and if or when, do I say if or when? When that, let's go positive, when that comes off, that's free to access. It's gas that can go global, so it's free to access both nationally and internationally. So let's make him welcome. This is Neil Young. He is their MD, and hear the story of Elixir.
Thank you. Pleased to be here again. We have a short video which I'll ask the team to put on when I say, probably about halfway through. So please be ready. Thanks, guys. So firstly, company overview. We have 3 projects. The one I'm going to talk most about today is the Grandis gas project in Queensland. We've already booked nearly half a TCF of 2C resources there, and for reasons which I'll expand upon later, we anticipate significant expansion thereof. That project's 100% owned. As the lovely introducer said, that can access domestic and international markets, and we have an imminent high-impact well due to spud next month. Mongolia, we've been working for 4 or 5 years. Again, we own 100% of this. Again, location is fabulous. It's next door to China. Our team is highly experienced in coal seam gas, and we've had a pilot production project going throughout 2023, which we're imminently expanding. Our last longer dated project is the Gobi H2 project located in Mongolia. We heard from BP about its hydrogen project here in Australia. That's somewhat further away from the energy markets than ours. We have very high quality wind and solar. We've got a fabulous partner in the form of Toyota Tsusho. So our team, firstly, the cap structure is slightly out of date. We've just done a placement, so number of shares up, cash up, share price down. In terms of the board of directors, it's been mentioned a few times today how long you've been going here. I first saw Richard Coddy here in 2005 when he was CEO of QGC. Its market cap then was about similar to ours. About 4 years later, it was taken out for $5 billion. Myself, I've worked for companies big and small. Steve Kellerman was a colleague of mine at Santos. In that era, he developed a coal seam gas business and is a 40-year veteran, highly respected by everyone who knows him. The last person here, but certainly not least, is Anna Sloboda. She's at the conference here, and if you want to have a chat to her or me, please come out to our booth. So the Grandis gas project, the location is superb, about less than 100 k's from the premier gas hub in Australia of Wallumbilla, a hub not only in pricing terms, but also in infrastructure terms that takes gas to the desperate southern states and also to the plants in Gladstone, which have ullage, which is growing. Market factors are now encouraging drilling not only by us, but by others. For the first time in nearly a decade, BG drilled here, spent $300 million 10 years ago, and now Shell is coming back, Santos is there, plus there's us and and some other, another junior, Omega Oil and Gas, who will present tomorrow. Our well is due to spud in the end of October, and the Australian government is generously going to fund half of that under its R&D scheme. We have a binding advanced finding to that effect. So I want to introduce here, I think, a really interesting concept which WoodMac has developed recently, what they call an energy superbasin. And in their view, energy superbasins are the future, and they are locations where hydrocarbons are co-located with carbon capture and storage and renewable energy facilities. We can already see that in the Permian Basin in the States, which has had CO2-based EOR for a long time, and now Occidental, for example, has got a major multi-billion-dollar DAC project here. Now, Grandis is located, in our view, in such a basin. Now, there's TCFs of contingent and prospective resources here. There's overlapping GHG licenses, which are CCS licenses under Queensland law. They're owned by Glencore and Origin, and there's also major electricity infrastructure that connects basically through the region. There are thermal power plants, there are solar power plants. Ultimately, Scope 1 and 2 emissions here can be eliminated by, for instance, electrifying drilling. Why is this relevant to a junior? Well, juniors want to be where majors are going to come, or already are. And if WoodMac believes that this is a major theme, that is a massive endorsement to me as to why the energy super companies around the world are going to want to be here. So the Taroom Trough, we see a map here. It hosts us in the middle acreage, Santos to our immediate north and south. In the southern block, Santos is in JV with Shell. Shell are to our west and north. And recently we came across a otherwise very, very tight piece of information, which we found on the web, we believe as a result of a Freedom of Information request by a third party. There's a link there, you can go and look at it if you want. It's a few hundred pages long, largely redacted. But the key point here is that Shell has said that in their PCA 305, that's a retention lease, they've got 3 TCF of gas and 250 million barrels of liquids. So a few staggering points to come out from that data. Firstly, if Shell's saying that, that's likely a conservative number, which means that our number is very conservative. It probably means the total play is 10 CCF of gas at least. And on that sort of liquid ratio, there's maybe 1 billion barrels of recoverable oil here. That's just staggering. That's more than the Cooper Basin's produced. Kevin Gallagher joined the party, making a statement here a few years ago, which one would expect from the lips of someone like me at a conference like this, saying that if the play works, then again, it's multi-TCFs. Our position is far more modest and understated at this point in time. We've formed a BCF of 2C and 1.3 TCF of prospective. Now, we strongly understand, based on talking to the contractors in the region, that the large operators are undertaking and will undertake significant programs over the course of this year and next. I'd estimate the total cost of expenditure by us, our peers, and the majors to be in the region of a few $100 million over the next few years. So our contingent resources, going into the detail here, we said 395 BCF of 2C. Our recoverable condensate is massively more conservative than Shell's number at 3.6. You can probably multiply that by 6 or 7 if you took the same ratio as them. And clearly an objective of our well is to affirm that condensate ratio. That will dramatically improve the economics of this play. The prospective resource is in the fractured coals here. What we have in the Taroom Trough is in effect a layer cake of sandstones, coals, and shales. The contingent resources are only booked in the sands because that was all that BG flowed a decade ago. We believe that coals can flow here, and as and when they do, that will dramatically increase the contingent resource. So here's our timeline. We have signed a rig contract with SLB, or Schlumberger, better known as. We're undertaking well planning and preparation, which is highly advanced. We procured the long lead items that we need. We will spud this well when the rig comes from Fairview, which is not far away, and we're confident that will be in around the last week of October. That well, we estimate, will take 30 or 40 days to drill. The same rig recently drilled for Omega and delivered a fantastic drilling performance there. If that's replicated, we'll reach TD by around the end of November, start of December. We'll log that well. This is an appraisal well. We're highly confident it will come up with a very thick gas-bearing section. Then we'll take the time over the summer holidays when the market's asleep to plan our stimulation program. We'll commence that in Q1. It's a significant stimulation program in a vertical well, probably 7 stages into the sands and the coals, individually flow test each level. We'll then do a flow test at the end of that and hopefully be on the path to seeing if we can book some reserves. Might not be feasible in the first well, of course. One advantage we see of multiple operators doing multiple programs here and using different techniques is that someone will crack the code, and if it's not you, it doesn't matter. You will learn from the other guy. Your acreage is still immeasurably increased in value by what the other guy has done. So if we've got time, maybe we can just show our video now.
Elixir Energy is about to drill the most significant well in the company's history, Daydream 2. This well is located in the Southern Taroom Trough in southeast Queensland. The project is close to existing gas pipeline infrastructure. Any produced gas will have access to both domestic and international markets. In 2012, BG, now Shell, drilled a number of nearby wells that all intersected and flowed gas. In 2023, 2 new wells have reported thick, gas-saturated reservoirs. Elixir's Daydream 2 well is located less than 5 kilometres from Shell's Daydream 1, making it a lower risk appraisal well that is targeting large volumes of gas. The presence of gas in this location is almost certain. Succeeding with completion and production is the main goal. These have much improved since 2012. Geologists have modelled the rocks in the Taroom Trough and predict there will be around half a kilometre gross thickness of gas-saturated rocks at Daydream 2. Elixir will evaluate the potential of both the gas-bearing coals and sandstones whilst drilling and expects strong gas indications once the Permian-aged section is intersected. The key to success is to maximise the flow of gas from multiple zones. This means focusing on testing the sandstone and coals separately before combining them all for production. Elixir's team will be using a raft of novel R&D technologies along the way, and a recent government finding means Elixir will be paid a 43.5% rebate on the total costs of the well. In coming months, Elixir expects its news, analysis and results to be very closely followed by both the gas industry and investors.
Thanks, guys. That was obviously a fairly simple illustration, but we found it really useful for our shareholders to understand what we're trying to do here and where the risks do and don't actually lie. I've only got a few minutes left. I'll run through our Mongolian CBM asset first. Overview here, a very large PSC, the first to be granted in the country. We've had a few followers since, and I very much look forward to hearing from TMK tomorrow. They're a great peer of ours, and indeed we now see increasing cooperation with the likes of us and them and the others in the country. We're all learning from each other, and as I said in the Taroom Trough, that's what you want to do. You're not competitors, you're collaborators in the end of the day. So we've had an extended pilot production test on since the end of last year. It's the first in the country. We're learning a lot from this. Initially we had 2 wells, only a close distance from each other. We've just spotted a 3rd pilot well in the same location, and we'll connect that to the production facilities and bring that on, hopefully within around a month. The production, we've had water over that entire period at fairly flat rates. We had very strong rates earlier. They fell off a bit and then have come back, and we've got lots of thinking as to why that's been the case, and which has driven the design and implementation of the 3rd well in the pilot. So this year's plan, other than the pilot, is to engage on the gas marketing front. So this is a frontier nation for gas. There is no gas in the country to date. Obviously, the reason why we're there is its immediate neighbour to the south is the world's largest energy importing nation. Our appraisal and exploration program in parallel to our pilot involves 9 wells in total. We'll have an update on what we've been doing there soon. We've been concentrating this year's program in the middle of the year. Mongolia is pretty cold in winter. It is not subject to heavy snows and such like as you'd get in Alaska, but certainly for the guys who are on the ground, it's preferable to be working in the slightly warmer months. So our hydrogen project, again, is based on locational advantage. Mongolia has fabulous wind and sun, and it's next door to China. If you're exporting hydrogen from Australia or Namibia or any other locations in the world, you're going to pay probably 4 or 5 times more than the same energy or content of methane being moved over the same distance. We're working with a Japanese partner on this. It was SoftBank. They sold out their renewable energy assets to Toyota Tsusho, who now owns about 5 gigawatts of renewable assets around the world, including in Australia and Mongolia. That's a $5 or $10 billion renewable energy business as part of the Toyota group, and a pretty fabulous partner for a company of our size to attract. And as we've gone through the course of the year, we've moved from an MOU to a term sheet, and we aim to go into a binding IJV in due course. The progress of that is contingent upon securing customers, and I think it's true to say in the hydrogen world that there's a lot more people want to produce it than actually want to buy it at this stage, but in the long term, we think this project's got immense scalability that will be required in China, and China is the world's leader in hydrogen just now at this stage, without a doubt. That's not obvious in the Western media, but it's illustrated pretty well here in that Sinopec earlier this year basically FID'd a 400-kilometer hydrogen pipeline. Now, that's the only one in the world of that length. It's in the Chinese province of Inner Mongolia to our immediate south. It's very easy to posit in the decades to come that sort of hydrogen network could extend a fairly short distance to the north and connect our project. I think that's me.
Well done, good, well done. Thank you so much. Right, they were your investment opportunities today. Now, this fellow here who's joining us on the stage, I'm sure many of you know him pretty well. It's Kevin Johnson. He's Executive Director of Argonaut Securities. He specialises in providing share market advice, portfolio management, trade execution services for both domestic and international private clients, corporates, international brokers, resources funds. If you are leaving us right now, goodbye. Turn on the radio on your way home, because you'll hear this fellow. He's on 882 every afternoon with one of my mates, Oliver Peterson, and he gives a stock market report. So make sure you're listening in on that one. And I'm listening to him and his passion for the share market. I would hazard a guess, Kevin, that you've never actually worked a day in your life, have you?
I work every day.
Yeah, you love it. Okay, so look, since we have a stock market expert with us, we thought we would pose the question to him. You always have to do your own research. You know that. You need to do your own research. But we have this enormous brain here, and we put the question to him: why bother investing in oil and gas shares? Why? Would you please give him a warm round of applause to welcome him?
Thanks, Chrissy. Yes, in fact, that's a very important question. Watching people here today, listening to all these things, and you sort of see people writing down, oh, maybe I should look up the price of that one. Maybe I should look up the price of this one, because it's a fascinating industry, shares. I mean, there's various shares of various industries, and I've got to say, we go back to 2015 at Argonaut. We were heavily involved in the oil and gas sector. We actually did a whole piece on the renaissance of the Perth Basin back in 2015, and decided there was lots of gas there. We were that far advanced with my business partner, Eddie Rigg. We even set up a drilling company called Enerdrill. And the whole idea was we'd find the Waitsia gas field, and we'd drill into that, and they'd have to drill 21 wells to prove up the field, and be fantastic. We'd make lots of money. Well, what happened is they found enough gas in 2 holes and didn't need the other 19, and then the drill disappeared. So it was very sad, but it showed that there was an enormous amount of gas in the Perth Basin against what everyone thought. And I think that's the sign of the times. And that over the years, my interest in oil and gas shares disappeared. I traded a few from now and then, but just wasn't really interested at all. And when I got the call up for this, because Eddie couldn't do it and David couldn't do it, I thought, why bother investing in oil and gas shares? And I must say, in the last week or so, doing a lot of research and thinking about this, it actually is becoming quite interesting. And there's a lot of examples as to why you should. I also posed the question to my colleagues. We have a morning meeting every day at Argonaut at 9:15. And I said to the guys, why invest in oil and gas shares? And the responses, as you can see there, from Glenn Colgan, of course, to make money. Eddie, of course, decided if you want to own oil and gas shares and the petrol price is going up at the Bowser, it's your way of hedging against it because you're going to make money. Other fellow jumped in and says, well, it's a hedge against failing electrification transition. His view is it's just not going to happen as fast as you think. So the demand for oil and gas is still going to be well and truly here. And as some of the young people pointed out, the future isn't here yet. Now this bit gives me credibility, of course, so I can quote one of the best investors in the world. And this was actually from last year's slide when David Franklin did it, our funds management gentleman. As he pointed out, there may well be an opportunity for oil and gas companies. And I think we certainly saw that. And I've just put some examples up there. If you look at Chevron, for example, they spoke, I think, at the opening of today's program. They've had a great year. They were sub $100 and now they're about $160, $170. The scale of this doesn't really do it justice, but they're up 69% this year. Santos have had a volatile year, but they're still up. Woodside, probably the best of them all. I mean, obviously they bought the BHP assets and they turned that into a lot of cash. They've been increasing their dividends every year and the shares have done very well. They're up around $38 now. And you look at those charts and you think, oh, well, the oil price, and just the bottom right-hand side is, of course, the oil and gas in the ETF, OOO it's called. But if you think, oh, the oil and price must have done really well. Well, frankly, it hasn't. You know, it's actually was doing well. And then, of course, we had the problems in Ukraine. We've got problems with the Russians selling gas through the back doors to various countries like China and India that would, that can afford to do it and not upset the West. But now we've seen them cutting production, both in the Saudis and here, and they're still making good money. So that is an important thing to do these days, of course. Now, of course, the research I've did, of course, is the 7 companies that have preceded me today. And obviously, we've heard various presentations from various people. And you would think, given what's been said, that they'd be going fabulous. But as you can see, not all of them are. And I think there's 5 up there, and it's been difficult. But of course, there are some that are doing quite well. So it's actually been okay. And so when I looked at these 7 companies, I've got to be honest with you, I only heard of one. And I thought, well, I better start reading into this. I spent the last few days reading and looking. And I thought to myself, right, what would be the cumulative share price of all these companies? Would it be 10 cents? Would it be 20 cents? It's actually 61 cents, which I was quite surprised by. Then I added up the market capitalizations. I was very surprised to find it's $566 million, just these 7 companies today. So I'm sure tomorrow with a much bigger field, they'll be a lot higher than that. So that was quite interesting. Then I thought, well, do any of them actually get any revenue? Well, only 3 of them do, in fact. And it's a total of about $24 million. But as you saw from the last gentleman, maybe that'll rise. And the one before that, maybe that'll rise in the next few years. Cash at bank, well, I went through the quarterly reports as at 30th of June, 102 million between these 7 companies. Obviously, some have got a lot more than others, but still, it was quite a pleasant surprise. And then I thought, I know what happens with these companies. They've all got billions of shares, and it should be 3 billion or 5 billion or 10 billion. No, that's mainly for the oil and gas. I mean, up for the resource shares these days, I can tell you, because between them all, only less than 9 billion shares. So that was a pleasant surprise to find that out. Then you think, okay, if you're looking at these companies thinking what can happen in the future, I think if you'd probably thought the same thing about coal companies 2 years ago. They were on the nose. Every ethical investor in the world, it was a soft target. You know, they could say, oh, we're an ethical investor and we're not going to invest in coal companies. Well, didn't they cost their shareholders some money? Because, of course, Whitehaven is up 120% so far, but it's obviously been higher than that in the last year or so. Same for Yancoal and same for New Hope. They've all generated billions of dollars in cash and they've been paying very good dividends. Of course, then you have other issues that can arise, which is commodity price rises. Now, 2 to 3 years ago, the price of lithium was $300 a tonne. Altus had already gone, Pilbara on the edge. Next, you know, that everyone suddenly decides they need lithium, as we've all seen with the electrification process that's going along. It goes to $6,000 US from $300 US. So 20 times moved. Now, just to put that in perspective, it's equivalent to the gold price being $30,000 an ounce. It's currently $2,000, or close enough to it anyway. Or the oil price being hundreds of dollars, probably $600 or $700 or $800. So it can happen. And we've seen it happen in recent times. This is not something, I'm not digging back into the future in the 30s and the 40s and the 50s. This is something that's happened reasonably recently. Obviously, Pilbara have done very well. They just paid their first dividend. Liontown, we've had an overseas company come and want to buy them for $6.5 billion. And Azure, I put that one in there because for a number of years it just sat there being a nickel company, or maybe gold, or maybe whatever the hot commodity was at the time. But then they did some work, and in fact a major company came down, and this is a common theme of what we've heard today about major companies coming down, looking where juniors are. They came down, they looked at it, they said, oh, do you mind if we go across our ground? And so SQM went out to Azure's ground, they did some work. We like what we hear, we see parallels to other deposits we have. They put, I think, $20 million in at 60 cents a share, or might even, the numbers might be wrong, but they put some money in there, they did very well, they own 19% of the company. Then they started drilling, and look what they found. Now it's a $1.2 billion company, and they only own 60% of the deposit. So these things can happen. That's right. I put this one in because 10 or 15 years ago, Norwest Energy was very much, a stalwart of this conference, and it appeared many times. I think Shelley was running it at the time, and they were drilling an offshore well very close to the West Australian coast. I can't remember which town, but it might be Cervantes or one of those just offshore. Energy was going to drill the well for them. It was one of these long horizontal things out there. The shares were 0.2 or 0.3, billions of shares on issue. It ran up to 1 cent. They got a sniff. No, they didn't get anything. It disappeared. Now, it just swallowed along, but they stuck at it, and they had some good acreage in the Perth Basin. And of course, then MinRes and Chris Ellison come along, and they drill into the Perth Basin, and they find some gas in Lockyer Deep. So, and look at the performance. It got taken out at 7 cents, and that's the end of, and that's, been a good situation for them. And it's a reminder to me more than, I put this up there for myself actually, not necessarily for you, to remind you, you've got to stay sometimes a long journey. You can't lose sight of these companies, and you can't lose sight of these investments, because it can change. It can be a drill hole. It can be a major coming by. Always something can come along. That's why the share market's so good for things like that. Now, it wouldn't be unfair. David, of course, was here last year talking about his funds and how they were going. They're up 27% so far this year, and in what has been a very tough market for resources. Who knows, maybe next year Argonaut as well. We set up a gold fund the last 6 months. Maybe we'll set up an oil and gas fund. I'm not too sure. We've got to find some people to help us out with that. But certainly it's been a good area for us. I asked David today, does he have any oil and gas shares? No, he said. We'll have to change that, won't we? And one final thing, if I just go back to what I learnt here, the Perth Basin, I can't leave you with anything without a prediction, and my prediction is that they will find oil in the Perth Basin. There was a number of holes drilled over the years. They all stopped at a certain depth. They had never drilled really deep for gas. The first time they did that, they found a lot of gas, in fact enough gas to run Perth for many, many years. So it's an interesting market. You've got to stay the long journey, and doesn't hurt to own shares in companies. Chris, you got time for a question?
I reckon we do have time for a question if you like one, because you finished nearly 10 minutes early. I just looked and thought, are you sure? You usually have more to say than that.
There's drinks to be had.
All right, Jeffrey, introduce yourself, please.
Just a quote from Fred. Fred said, buy low and be patient.
That's right. Thank you. Right said, Fred.
Shouldn't have let him have that. Anyone else? Anyone else like to add something considered to this conversation at all?
No, I think we all need a drink, and Argonaut's happy to be paying for them, Chrissy.
That sounds wonderful. Come and join us, everyone. And for those who are coming back tomorrow morning, 8:50, we'll see you in the room. Would you put your hands together for all our presenters, please?